Welcome to the Capital News. I am your host, Alex Karitis. Today is November 26, 2019. Thank you so much for joining me. Title of today's podcast is A Debt-Fueled Market. Of course, most of you who have been with me know exactly what I'm talking about. Although instead of really focusing in on the Federal Reserve on this one, although they are the main culprit, we're actually just going to look at some of the corporate debt metrics. And really, I'm only going to focus on one here in today's podcast, and we're going to talk about some other things too, a little bit of the politics with 2020, especially since Michael Bloomberg is in the race. Elizabeth Warren, she doesn't like it. Bernie Sanders, they don't seem to like it. And surprise, surprise, they attack the billionaire class. They themselves, I understand, are both millionaires, so I don't think they want to attack millionaires per se, but the billionaire class, because they're a step above them, well, Michael Bloomberg falls into that category, so they are attacking him. I also think it's really not a logical argument. We're going to talk about that later on in the podcast. And it just doesn't hold any water, but that's what they do. They have to attack people. And I think it's going to be quite insulting to their own voters. Do their own voters even understand that? That's ultimately going to be the question, but we'll get to that. Some Chinese data that came across the wires this evening. Chinese industrial profits are down. They are down, continuing their downward descent, 2.9% year to date. Not good, folks. This is not just because they're not buying soybeans from the United States or pork bellies from the United States. They are sourcing those products from somewhere else. This is a global economic slowdown. This is a market in China that has been fueled by debt itself. For the past decade, China has been fueling their growth at the expense of future growth because of the amount of debt that they have accumulated. By some analysts, by some metrics, there's $40 trillion of debt in their system. $40 trillion worth of debt. U.S. dollars, not Chinese dollars, U.S. dollars. That's astronomical. Astronomical. The national debt here in the United States is $23 trillion. And we have a whole host of problems ourselves. The Chinese overextended themselves. They've built cities to nowhere, ghost towns. Look them up. They're on YouTube. I mean, it's eerie. It's like a Western. I mean, this is like it's like a movie in the end of days. You just got these ghost towns. You got tumbleweeds. It's an eerie feeling. And that's just watching the journalists walk around these towns. I mean, you just watching it. There's like an eerie feeling. What's going on? It's sort of, if you build it, they will come. And in some respect, that has proven to be the case. But in others, no, not so much. And then you have to take into consideration, what about all of the costs, the upkeep costs of all of those buildings, of all of those structures? If you don't have people in them, who's paying for them? I mean, ultimately, those buildings, they have to breathe. There has to be ventilation. So who's going to turn on all of the HVAC systems and all that type of stuff? Who's paying for all of that? Some of these things might go overlooked. But China has overextended themselves. They were able to sort of keep the global economy humming along for the past 10 years, especially during the depths of the great financial crisis, the Great Recession. That's no longer the case. Now they're on the other side of that coin. You can't have it both ways. Well, they led the world out of this, and now when they're going down, everything's just going to be A-okay. It's not. They're going to take everybody down with them, just like they help bring everybody up. This is the other side of the coin. And because they did it to a degree at which they did, to the rate at which they did, I think the other side of this, the downside, is going to be very, very bad, to say the least. And nobody is going to be safe from this. Not the United States, not Japan, not South Korea, not Australia, Canada. The global economy is interconnected. Very much so. And I hope you start to understand that as we make our way through this podcast and the entirety of the Capital News since we've been online, since February. That's the whole purpose of this podcast in one part, is to explain the interconnectedness of the global economy. Because you can say, yeah, what difference does it make? It's over there. Well, just wait and see. Just wait and see. If car sales are down in China, how's that's going to affect the economy in Europe, which it is. How a slowdown in Europe will have an effect on a slowdown here in the United States, which it is. It's just the truth of the matter. So you have to be prepared. You have to stay diversified. You have to stay vigilant, as I like to say here. So we're going to look at that. We're going to focus on debt securities, which are debt for corporations, and we're going to look at loans as well. So not just the corporate debt securities, not just the bonds that are outstanding, but we're also going to talk about the loans. And I'm not just talking about U.S. corporations. Actually, what I'm going to be looking at here for today's podcast is the rest of the world. Okay? And right there, you're talking about a number that is over $4 trillion. Over $4 trillion. And we're going to benchmark that against the Wilshire 5,000 total market full cap index. So this is basically the totality of the stock market against the rest of the world's debt, bonds, and loans. Okay. I think it was even in yesterday's podcast, I said, there's really no reason for me to be doing many videos, and I haven't posted a video in a while. And I said my reasoning yesterday is because these markets just continue to climb. The major indices here in the U.S. were all up about 1/4 percentage point, 0.3% in some of them. They don't care. They just keep going up. It doesn't matter what Chinese production numbers are, what Chinese industrial profits are. It doesn't matter that you have metrics all over the United States that continue to show a slowdown or deterioration. It doesn't matter. Across a whole host of industries, across a whole host of metrics. The stock market doesn't care. Why? Because the Federal Reserve, the ECB, the BOJ, everybody else and their mother is printing money like it's going out of style. Why? Because it probably is going out of style. Which is why you should have some substitutes. You should have some precious metals, some gold and some silver. Not just the ETF, you should probably have some physical gold and silver, in my opinion. Do your own homework. Just to stay diversified to some degree. But the markets don't care. But I might do a video on this because this isn't really just about the underlying fundamental economic data. This is actually look at the debt and look how the stock market reacts to it. And it's basically a correlation of 1-to-1. It's really sickening when you look at it. So I'm going to probably do a video of this. We're going to look at, obviously, the rest of the world, the debt securities and the loans against the Wilshire 5,000. But we're also going to look at the U.S. corporate debt market as well when it comes to this same type of analysis. But that will be in the video. We have some other pressing deadlines. And it's going to, I think, relate to these markets because it has to do with U.S.-China trade talks. But this is really more predicated on Hong Kong and what transpires there because we talked in previous podcasts how unanimously in the House and the Senate, they sent a bill to Donald Trump's desk in regards to the Hong Kong Human Rights or Democracy Act, whatever they're calling it, pretty much denouncing what's going on over there and saying that the special trading status right now that Hong Kong enjoys is going to be coming up for review on an annual basis until there is some more clarification as to what's going on in regards to Hong Kong and China. Because recall, Hong Kong is very much a part of these global protests, and Hong Kong has the potential to throw the entire global economy into a downward tailspin. And that's not an exaggeration. They are the financial gateway to China. So they are hugely important to China. They have one of the most overbought residential markets in the world, if not the most overvalued, bubblicious, frothiest real estate market in the world, and a whole host of other issues. And they've been protesting for 6 months. So that bill, in a bipartisan manner, has now found its way onto President Trump's desk. There is a deadline as to when he has to sign it. That date is December 2nd. December 2nd. So we're talking less than a week here. He has a week to sign this thing. What's he going to do? Because the Chinese have already stated, before this thing was even passed by both houses, they said if this thing is passed and it becomes law, they will respond in kind. Now, they didn't give any specifics, but that's not good, folks. And it's probably not going to bode too well for this BS Phase 1 deal either, which was, I thought it was agreed to a month ago if you listen to Donald Trump. But of course, you don't listen to that man. Like I've said, yesterday's podcast, no credibility, no problem. It's a problem with me, but clearly the markets don't give a damn and nobody else does either. It bothers me, though. A month ago, standing in the Oval Office. Yeah, we got a deal. Phase 1, it's coming. Just got to sign it. That's all. Some minor details. Not going to be a problem. There's nothing. There hasn't been a signing ceremony. There's been no deal. There's been pushback. Nothing. Nothing. So he has until December 2nd to sign this thing. If it doesn't happen, I don't know what the actual legal basis for it will be. If it has to go back, if he doesn't sign it, is that the same thing as him vetoing it? I don't know, actually. So I don't know if it would have to go back to Congress, but clearly it was passed with unanimous consent. So they could override the veto. Something's going to have to be done. The president is going to have to make a decision here. What's he going to do? Is he going to stand up for American values? Is he going to stand up for human rights? Is he going to stand up for the right to protest and side with the American people? Because remember, folks, it wasn't that long ago, and we covered this in a podcast, when Mike Pence came out and was playing, the good cop, bad cop. Good cop is Donald Trump, bad cop Mike Pence, maybe. He's out there going against China, their human rights violations, talking about Hong Kong, talking about the NBA when that was a little bit of a scandal, because NBA was more concerned about their profits as opposed to sticking up to American values. Remember that discussion? Well, here it comes, full circle. Donnie Boy's got until December 2nd to make a decision. And what's he going to do? Is he going to kowtow to the Chinese and bend over? Because if he does this, there's no trade deal. And what's the market going to do? The market's only priced in a trade deal, 200 times by now. Over the course of a year and a half, going on 2 years. The stock market's already priced in a fantastic trade deal. But what happens if it doesn't exist? Because he signs this thing into law. Complicating matters even further today, Secretary of State Mike Pompeo comes out and makes comments in regards to China's human rights violations when it comes to the Uyghurs and the concentration camps or the re-education camps, whatever you want to call them over there too. So that's not going to bode well either, folks. This is all interconnected. Will Donald Trump stand up for American values and principles and for these human rights atrocities? Or is he going to say, oh no, my precious stock market, we can't, I can't take a hit. I can't take a hit. So protesting, freedom of speech, right to protest, be damned. People in re-education camps, be damned. I don't care. I want the Dow to keep going up. I want the NASDAQ to keep going up. I want the S&P 500 to keep going up because Thunder Thumbs, all I want to do is keep tweeting record highs, record highs, record highs. Which is interesting verbiage too, by the way, because that's all this is. It's all a drug. These markets are just running off of fumes. They're just high. That's all it is. The meth addicts, the crackheads on Wall Street, they just wanted their fix. They're getting it from Donald Trump, and they're getting it from Jay Powell and the Federal Reserve, and the ECB and the BOJ and all these other idiots all over the world, printing money. At what cost? Well, you're going to find out when this all implodes and explodes on everybody. You're going to find out. You think you're real smart just buying something and holding on to it because these idiots are printing money, and this money's got to go somewhere, and mysteriously, miraculously, it's making its way into the stock market. You better watch yourself. That's all I'm telling you. I don't want my profits. I don't want my 401k going up at any cost, at any price. Donald Trump doesn't care. He doesn't care. It goes up because of funny money. He doesn't care. He just wants it to go up. He just wants the charade to continue. He just wants the con job to continue. Instead of coming forward, instead of being the true leader of the free world, instead of coming forward and defending American values and leading by example, because that's how it's supposed to be done, leading by example through rhetoric, not through the end of a barrel of a gun with these endless wars. No. It's supposed to be done by leading through example. Well, this is a prime example. You have protesters in Hong Kong singing the national anthem on occasion, marching with American flags. This is a prime opportunity. But if Donald Trump steps up to the plate and actually acts presidential for once, his stock market's going to take a big hit. And it's not his stock market either, by the way. Newsflash. He shouldn't be involved with this to begin with, but he's obsessed with it because all he gives a damn about are profits and numbers that keep going up, up, and up at any cost, any expense. I told you this the other day. If he can continue to juice these markets by lying and sending out his lackeys one after the next, coming out and saying, oh, we're close to a trade deal. We're close to a trade deal. We're getting closer. We're in the final laps. We're at the short strokes. Ba, 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 ba. The market's going to keep biting on it. Why would he ever sign something? Well, now he's going to have to make a decision here because Congress is pretty much forcing his hand. You're going to have to make a decision finally, Donald Trump. What's it going to be? You're going to sign this thing? You're going to stand up for American values? You're going to side with your own vice president, denouncing these human rights issues that are taking place in China? You're going to stand up for the right to protest? You're going to stand up for the freedom of speech? Or you're just going to say, oh no, my stock market's too precious. I can't step away from this trade deal that isn't. And if there even is one, is going to be a phase 1 deal, and all maybe it's going to do is take us back to where we were 2 years ago. Although miraculously, you're not going to have all of those farmers who lost their jobs come back. Not going to happen because they're gone. They went bankrupt. They're gone. See you later. All of those plants that closed their doors, now they're not just going to miraculously open up again tomorrow because there's a miraculous trade deal that's signed so somebody can sell more soybeans. Not going to be happening. It's not how it's going to happen, folks. And I can pretty much assure you that somebody in the White House knows this. Donald Trump probably is even aware of this. That's why he doesn't want to sign anything, because he knows the reality on the other side. He knows the risk of the reality on the other side. But if he can continue to make these lies and these misleading statements and just continue to say that we're close and the market keeps biting on it, he has no incentive to sign anything. But now he does, and he's got a week to make up his mind. Very interesting. Maybe that'll put some cold water on this melt-up rally. Maybe this will put some cold water on a potential Santa Claus rally at the end of the year. Who knows? Or maybe there's actually going to be a signing of something. Maybe they're going to agree. And that's not it, folks. It's not just this December 2nd timeline and deadline. December 15th, new tariffs are supposed to be imposed. So what's he going to do there? Will he sign the Hong Kong Act into law? Or will he sign it into law and also increase the tariffs? Will he sign it into law and say, well, we're going to pause on the tariffs because, I don't really want to do that, even though he's the tariff man, he's the strong guy here? Or is he going to completely cave, not sign it, and not increase the tariffs? I mean, these are the signs. If you see that type of action where he doesn't sign it and where he's not following through with these tariffs, then he doesn't give a damn about American values. He's more concerned with his stock market. And again, it's not his. So that's all you need to know. That's what he's obsessed about. The very things that Mike Pence was complaining about, and rightly so, against the NBA and others. And he shouldn't have just went after the NBA. He should have went after a whole host of American companies. But guess what would have happened if Mike Pence talked about Apple and Microsoft and a whole host of other U.S. companies who do business in China, or companies that want to do business in China, and they want to do so at the expense of anything. They just want access to that market. Well, the markets would have went down too if Mike Pence had gone after them. But he didn't. He went after the NBA because they were the low-hanging fruit. They were the headline, the news story for the week. And they want access to 1.4 billion people. I don't blame them. But when you have human rights atrocities, when you have re-education camps over there, when you have a Chinese Communist Party that keeps people under their thumb, that's somewhat problematic. And when it puts profits ahead of values and principles in this country, we have a problem. We have a problem. And I was talking about that yesterday. No credibility, no problem. A republic if we can keep it. There's no republic. There's no law and order. It's a free-for-all. There's no values. It's just stock markets making record highs. That's all. And at what expense? Funny money and debt. And BS trade headlines. Don't the American people deserve better? Maybe not. Maybe this is exactly what we deserve because nobody pays attention. Because we're more concerned about the NBA and the football scores and those stats and figures as opposed to $23 trillion in debt, trillion-dollar deficits, fraud and abuse in the billions of dollars in this country. We're more concerned about sports statistics than we are with statistics that affect our own bottom lines as taxpayers and citizens of this country. Maybe we have the government that we deserve. And isn't that a sad state of affairs if that's the truth? So December 2nd is a deadline for Donald Trump to make a decision if he's going to sign the Hong Kong Human Rights Democracy Act into law. December 15th is the deadline for increasing another round of tariffs. So we're coming down to the wire, folks. And in the midst of that, don't forget, December 12th is when the UK goes to the voting polls and has their general election. So you still have a lot of Brexit uncertainty in the midst of all of this as well. In December is traditionally a month where there's a squeeze on liquidity. And I mean, my goodness, we've been at a squeeze for liquidity for quite a while going back. Really, the signs really started to come to the foreground. We still really started to see the tremors in September when the Federal Reserve said everything's okay. It's just the end of the quarter. We're just going to get involved with the overnight repo market. Nothing to see here, folks. This is standard stuff. Don't worry about it. And we said, yeah, BS. That's a bunch of bull, too. And it has been. And so they've been priming the pump and priming these markets with liquidity ever since, and at a faster rate. And now we have lower interest rates once again, and we have quantitative easing once again, an expansion of the Federal Reserve's balance sheet, although they're not calling it quantitative easing, but that's exactly what it is. And they're increasing the balance sheet at a rate faster than what they've done in previous quantitative easings. So you want to know, I mean, if you've been paying attention to the Capital News, you're not surprised. You're not surprised at all. We were talking about this for a long time. One of my first videos was in regards to this very subject. Are central banks trapped? That was all the way back in July, before they made the decision to cut interest rates for the first time in a decade. And they are trapped, and they know it, because nobody's going to come out and be truthful. Nobody's going to come out and be a leader. Nobody's going to come out and admit fault or a mistake. It's not going to happen. You're not going to get it from Donald Trump. No fault, no error. You're not going to get any responsibility, no fault, no error from the Federal Reserve either, or the ECB, or any of these other central banks. Nothing. No leadership, no problem. Maybe that's going to be the title of another podcast. Nothing. Another stock market metric, I think I've talked about this in a previous podcast. Market cap to GDP is approximately 148%. This is about the same level it was back in 2000. The height of the dot-com bubble. What happened after that? Oh yeah, the NASDAQ collapsed 80%. No problem, folks. Nothing to see here. This is pretty much the Warren Buffett metric. This is what he likes to look at. Again, market cap to GDP, it's about 148%. And people ask the question, well, why Warren Buffett and Berkshire Hathaway and his right-hand man, Charlie Munger, why are these guys sitting on like $100 and some billion worth of cash? Why isn't he investing? This is why. Because the market cap is 148% of GDP. That's why. Buy low, sell high. You want to talk about people who follow that principle. I mean, they're only, some of the wealthiest men in the world. Buy low, sell high. They're not going to say, oh, yeah, well, we got $120-some billion here. Let's go buy everything with both hands at all-time highs. That's not how it works. These guys aren't stupid. They're waiting for their opportunity. They're waiting for the potential opportunity of a lifetime. And they're in their high 80s, 90-year-olds. They're waiting for the opportunity of a lifetime here on the other side of this disaster, because that's exactly what it's going to be. A disaster on the other side. When? I don't know. Wish I could tell you. Like I said yesterday, I wish I could tell you when the music's going to stop to make sure you have a chair. But I don't know. That's why I tell you to stay diversified. So getting to the rest of the world with debt securities and loans against the Wilshire 5000 total market full cap index. You can find this on the Federal Reserve economic data. This is typically the same data that I will use in all of my video presentations because it's a good source of data. So, I mean, I got to give at least Federal Reserve credit for that. They do contain and maintain a lot of data, and it's pretty easy to find too. But I know a lot of you might not have, be able to do so, or it might be intimidating to some of you, and that's fine. And that's why I'm here, and I'm going to be doing a video on this in the near future. But if you look at these lines here, if you look at this data, and you just follow the shape of these lines and the acceleration of the increase in debt, and then you look at how the total stock market has performed in conjunction, it's basically a 1-to-1 ratio. So goes debt, so goes the stock market. And what you can really tell from looking at this data is anytime the debt starts to slow off, it starts to plateau, or if it starts to actually slow down, the stock market sells off. But then it doesn't do so for long, folks. Don't worry. Debt starts to accelerate. And lo and behold, so does the stock market. And you can see this, and it is so highly evident, especially during 2016, 2017, and even parts of 2018. And then, of course, at the end of 2018, you saw that massive sell-off. Well, guess what happened with global debt? It also started to plateau and slow down. It's not just a coincidence, folks. These markets are bought and paid for. They're bought and paid for. They're bought for by central banks, giving this money out to corporations, and it's paid for by you. You think you're doing well in your 401k now, but wait till this thing collapses. And when you look at how the stock market has performed against the stock market itself from 2000 and 2007, the peaks of the markets of the dot-com bubble and the housing crisis. This eclipses it. We are totally past those levels. So if you would think, well, okay, 2000 we hit this level, and then 2007 we came close to that level again, and then boom, there was two sell-offs. You say, oh, well, that makes sense. Maybe there's something there in the market that it just doesn't like these levels. It's overbought. The valuations are out of whack. Okay, that makes some sense. Now we're completely beyond it. We are completely beyond the highs of where we were in 2000. We're completely beyond the highs of where we were in 2007. And this is why I've been saying for months here on this podcast that at the very least we are going to have a 40% correction. And the higher we go, the bigger the correction is going to be, because my level is still maintained at 2016 levels. And that's a minimum. That's a minimum. I think we'll overshoot that to the downside in quite a bit. And if it is a replay of the dot-com crash and you have a NASDAQ-like crash of 70, 80%, I'm not going to bat an eyelash. I am not going to be surprised in the least. In fact, that's almost what I would anticipate. But at the very least, you're going to see something around 40% back to 2016 levels. Because what we've seen, what we witnessed in 2018, at the end of 2018, was the plunge protection team, the central bank coming out and saying everything's going to be okay, Donald Trump coming out and say buy the dips. Nothing to see here, folks. I don't know if that's going to work next time. So that's why I say 40%, that could be it. If the Federal Reserve and whoever the president might be at this time, if that happens, they might be able to come out and calm the markets. I don't think that's going to happen, though. I really don't. So I think you're likely to see something that's going to be massive. And it's not going to happen overnight. But, that sell-off in the NASDAQ took a year and a half, 2 years to go down 80%. But the big drops in it, 20, 30, 40%, that can happen relatively quick. Relatively quick. I mean, last year we saw a 20% drop in a month and a half. If that happens again, what are you going to do? You're going to stay in, or you're going to say, oh my goodness, I got to get out of here? Because when it happens that quick, losing 20%, to get it back, you have to make 25%. And if you're close to retirement, it's a head scratcher. It's a big decision to make. I need the money. Do I risk that this thing is going to just rebound miraculously like it did this year? Or you're going to have some serious concerns that it's going to continue to either level out and sort of plateau, or that the sell-off could continue? That becomes a serious, serious question. And when we have 10,000 Americans reaching the age of 65 on a daily basis, and that's going to continue for the rest of this decade or the rest of the next decade, you got to ask yourself, what's going to happen with these markets? Because these retirees are going to start becoming net sellers. They already are becoming net sellers of stocks. And the only thing that has been keeping this market up is the funny money from central banks, the debt that has been going into these markets, courtesy of the money printing, and the share buybacks, which is financial engineering. By definition, it's financial engineering. This isn't on growth of revenues and profits. I said yesterday that corporate profits here in the United States peaked in 2014. They have. You can also find that data on the Federal Reserve Economic Data website. Corporate profits in the United States peaked in 2014. So this isn't because corporations are making fantastic profits. They're still making money. Don't get me wrong. Some of them are. Some of them aren't. Some of them are in trouble, believe me when I tell you. But they're still increasing some revenues. They're still increasing some profits or maintaining profits. But nothing that would justify these valuations. Nothing that would justify a market cap to GDP at 148%. Not even close. So I'm going to do a video on this because it's interesting to see this one-to-one relationship. And then when you look at it from a year-over-year basis, I mean, these charts are just on top of each other like white on rice. It's not even funny. So we'll do that. And then lastly, to the politics, the 2020 presidential campaign. Senators Elizabeth Warren and Bernie Sanders are attacking the newest candidate to this circus, former New York City Mayor Michael Bloomberg, and of course a billionaire with too much money, and we got to take it. If it wasn't for billionaires, I mean, who the hell would Senator Warren and Senator Sanders tax? Interesting question, huh? Of course, there's not enough money that these billionaires have in this country to tax. You could take all of their wealth, and you couldn't finance this government for a year. It's basic math. I don't know how these people have followers, especially to the degree that they do. I really don't. I mean, this is basic math, people. I mean, it's, I'm half joking when I call these people lunatics, somewhat of an entertainment factor to it. But at the same time, it's like, yeah, I'm half serious because this is basic math. This is basic math. I mean, you could take all of these people's money, everything that they've earned, and you couldn't finance this government for a year. Yet they have programs that are in the tens of trillions of dollars. And people just think, well, if I just tax Michael Bloomberg an extra 2%, we can do it. If I go after Mark Cuban or Bill Gates, Warren Buffett, Jeff Bezos, if I just take a little bit from them, we can pay for trillions and trillions of dollars worth of programs. Who's in charge of the education system in this country? Oh, yeah, that's right. The government. That's right. Maybe that's why they can't do the basic arithmetic. So Sanders and Warren are attacking Michael Bloomberg, basically saying, what's he think he's going to do? Is he going to come in here with all his money and buy up a whole bunch of ads? Or does he think he's just going to walk over people and just buy this election? That's rather insulting, don't you think? To all of their potential voters and some of their already supporters. I mean, to think that they can't think for themselves. That because Michael Bloomberg might buy a lot of airtime, he might have a lot of advertisements, that just means those people are going to see Michael Bloomberg on TV and then they're going to go to the polls and vote for him? That they're not going to focus on the issues? That they're not going to focus on the policies? I mean, that's quite insulting to say, well, he has money, so you're just going to follow him and vote for him. You think their people pick up on that they are insulted? Probably not. They couldn't do the basic math. You think they're going to come up with that logic? Probably not. Probably not. And again, they're not even talking about the story of Michael Bloomberg. And I'm not here to pretend that I am an expert on Michael Bloomberg because I am not. I am not an investigative journalist. This is a blog that I do here. But nevertheless, I still seek out the truth and justice. That's what this podcast is about. So if somebody has information on Bloomberg that is highly damning to his character, to his business dealings, I'll air it on this podcast. Like I said, I don't care who goes down. I don't care who's implicated in whatever. But give the guy a chance because he's a self-made billionaire. He wasn't born on third base and claims to have hit a home run. That's Donald Trump. And that's a whole host of other people in this country as well. Michael Bloomberg worked himself through college, got into the financial industry, made some good friends. They became his business partners, and the rest, as they say, is history. You have Bloomberg News, you have the Bloomberg Data Terminal, which is basically a must-have if you're somebody in the financial world, with all of the data that they house on that platform, and all of the information that can be used to make decisions on a whole host of topics. He built a better mousetrap. He is being rewarded for it. His philanthropy is in the billions of dollars. Pretty decent track record as mayor of New York City. You're going to have a hard time going after him. And I think Senators Warren and Sanders know this, and that's why they're coming out to attack him. The rest of them, I mean, they're so far back, it doesn't even make a difference. What Cory Booker says doesn't make a difference. What Kamala Harris says doesn't make a difference. They're idiots. They're off. They're working themselves off the stage. Don't worry about them. They'll be gone. Joe Biden, I don't know. Where's he at? Is he in Delaware taking a nap? I mean, Bloomberg, as far as I'm concerned, is down the middle. He will pull Republican voters. Unless, of course, there's some damning information that comes out. But then, I mean, can you shame the shameless? You got Donald Trump on the other side. So, I mean, it's going to be the battle of who couldn't care less. I mean, where are we at here in this country? But Michael Bloomberg makes the case that he's beaten Donald Trump before and that he can beat him again. And we're going to see what happens. This is going to be an interesting race. I mean, this is 2019. 1 year from now, we're going to have a president-elect. It could be Donald Trump or it could be somebody else. It's going to be a long, long and bumpy ride. We're not even done with this impeachment stuff. I didn't even get to that today. We're going to have to wait for tomorrow to do that analysis because it is going to be moving to the House Judiciary Committee, and there are things where that committee has already said in writing Donald Trump and his lawyers can come down and ask questions. So we'll see if the White House continues to stick to the story that they are not allowed to ask questions or have any type of representation. No credibility, no problem. So they'll continue to lie if that's the case. I won't be surprised. Neither should you. So today's podcast, a debt-fueled market, that's exactly what it has been. And that's off the back of no credibility, no problem either. We'll see what tomorrow brings us. We're closer to Thanksgiving, so let's put a smile on our faces the best we can and have an enjoyable moment with friends and family as that holiday approaches. So I'm going to wrap up this podcast here. I will catch you guys back here tomorrow. Stay diversified, stay vigilant, and stay with the Capital News. Please like, share, subscribe, get the word out, and do leave your comments. We love hearing from you. This is the Capital News. I am Alex Karitis. Godspeed.